Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands, the 20th day of December 2013, and this is the daily report for gold and silver. After a dramatic fall out of grace yesterday, in which we saw gold dip below $1,200 per ounce, we have it trading just around $1,200 per ounce. Whether or not it's able to close above 1,200 is something that we'll need to see, as we've got about an hour left in trading. But as we stand, market is currently trading up about $10 to $12 higher. The low 11.90.30, that low is significant. We will discuss that, of course, during the show. The high 12.08.50. Silver also trading higher this morning. It is trading up about 12 cents on the day, over $19 an ounce. As you can see, 19.35 is our current print, 19.08 on the low, and the high today is 19.64. Now, the first thing that I want to look at before we go into some of our intraday charts and longer charts to look at our forecast and what we're looking at through the end of the year, wanted to pull up this daily chart. On this daily chart, what becomes quite evident to me, if we take a look at the last week, and let's go ahead and highlight that. We have, of course, today, Friday, Thursday, Wednesday, Tuesday. This star up here is our star for the beginning of the week. And if you recall, we talked about a pattern that we identified, which was that three-river evening star. You can see that right in here. That's following what we identified as an incomplete dark cloud cover. Incomplete only because it didn't close at or below the midpoint of the prior green candle. But the pattern that we can identify right now is a piercing line. It opens at the low. Continuous contract, of course, when we're looking at spot. And it appears as though it will close at approximately the midpoint of the prior red candle, which is right here, of course. And then to take that call, you would look for the following candle, meaning on Monday, to get a green candle with a higher high and a higher low. On the daily charts, that would trigger a buy signal. What we find interesting is we literally saw this market fall out of bed as it broke below 1,200. We do have it recouping now, but the most interesting thing to me is the fact that we now have matching or equal lows in the marketplace. We'll talk about that in a little bit. I've gone ahead and pulled up a 240-minute chart, and what I'm looking at in this particular chart, of course, what we can see is really the most significant rally, the only real rally we had in 2013. Now that 2013 is almost over, we'd have to really make up a whole lot of ground to see another significant rally. Of course, we had a couple of minor rallies, but nothing like the rally we had when the market hit its low at 1181 and moved up to 1435. Because if you recall, we pretty much had a straight line down, aside from a couple of little blips in there, but a straight line down as the market went from 1800 all the way down to 1181. So now we have this low at 1181. We now have a low that's very, very close, just at around 1190. So under $10 away in terms of now having equal lows. If I draw it across, what you'll see is that, yeah, we do have a secondary low here. And so the question is going to be, will it now find support? Because if it does, it would probably take us into that fourth wave, 4 out of 5 on the fifth wave that we're looking at in terms of our Elliott wave count. But we'll talk about that in detail as we pull up our Elliott wave chart. Now, when we look at our 720-minute chart, this is in Japanese average format. You really don't get your true opens and closes, but what you can see is this double bottom that, at least for the weekend, appears as though we'll have. When we go ahead and remove the indicator, which is the Japanese average, then we can actually see this little blip up. You can see these last sets of green candles because now we're getting true opens and closes. So before we take a look at the market forecast for next week and some of our other charts, I wanted to take a look at these two charts that I've been analyzing over the last couple of weeks. Equities markets on the top, gold on the bottom. And indications of where different parts of the Fed's quantitative easing program are initiated. This is the beginning of quantitative easing right here, just before 2009, the onset of QE2, the onset of QE3, and then when they moved from $40 to $85 billion on monthly purchases on their assets. And of course, just this week, the announcement that tapering will begin, and they're back down to $75 billion, but they're now in taper mode. And what I found that was really, really interesting, of course, we had the stock market crash back in 2008. You can see that here. They roll out quantitative easing. Market continues to, of course, trade a little bit lower, but you start to get this effect of quantitative easing as the economy improves. And interestingly enough, as money is being pumped into the system, you've got the equities markets moving in tandem with the gold market. Gold is moving up because the belief is with quantitative easing, of course, that we're weakening the dollar. In other words, watering the dollar down. We're increasing any kind of deficit we had. I think we're looking at $3 trillion in terms of assets that have now been purchased by the Fed. And the economy does improve. And it seems as though, at least on the surface, whether it's quantitative easing or a combination of many factors, as the economy improves, stock market starts to really, really take off. We get to a point, though, where we get really a difference in the way that they react. And that happens really during the period of QE2. We get the top 1900 and we trade sideways for a while. While we're trading sideways, you can see the equities markets continue to move up. And when we hit this top, this is the third time we hit the top of 1800. This is really happening at the beginning of QE3. And at that point, we really see these markets move in opposite directions. Here you have the pretty much a straight down move in gold, as we witnessed it really this year move from 1800 down to 1200. And at the same time, we saw the equities markets rising to new and record highs in which they're currently trading at as we speak today. So the question becomes, what effect is tapering going to have for the gold market? Now, the fact that it's up today could be attributed to many things, and short covering might be one of them. However, I'm not convinced that we've gotten any kind of a bottom, and I do believe that we are still under some real bearish pressure. However, what we do want to kind of digest over this long weekend is going to be the simple fact that now the tapering has begun. How will that affect the precious metals markets? We're currently working on a model or an assumption, our Elliott wave model, that puts us in the final fifth wave of a 5-wave down move. Wave 1, wave 2, long wave 3, wave 4, and as I said, we're currently in 5. At that point, we've got two different scenarios or possibilities that we're looking at in terms of how this might unfold or unwind. One of those models is looking for what's called a truncated bear market or a truncated fifth wave. On a truncated fifth wave, typically you get equal bottoms between, or equal lows, between the fifth wave and the third wave. Well, this recent move down has actually fulfilled that criteria. Does that mean that this is where the bottom is? No, but it means that this is a really important point for us to actually begin to look to see if we're going to get that truncated fifth wave, because if we are, this would be the time that we got it. We've actually come down. Now I feel comfortable in saying that the lows have matched, and because of that, I want to be very sensitive to see if we get an upside move. Now, there's certain parameters we would see it break through to actually give us the technical evidence or the technical confirmation that, in fact, we have had a truncated fifth wave and are going into that A, B, C progression. On my final Outlook 2014, I am looking at both of those models and I am projecting where we think that might go. And as you can see on this particular chart, I've actually put in a fib retracement which simply goes from the beginning of the bear cycle, which I'm looking at 1800, because you have, as I said, wave 1 here. This is our high. Wave 1 equal to 2, and then 3, we've got our triple top up here. That would say that if in fact we got a truncated bear market or a truncated fifth wave, that A, B, and C in terms of the direct parameters could take the market anywhere between 1302 and 1397. That's assuming that what we are getting is this double bottom. And realize that 1150 is a really important number because it's a long-term fib retracement from a major move from 700 up to 1900, this being 61%, and it incorporates the entire run that gold had over a few year period of time. If in fact this particular low cannot hold, I would look for it to trade possibly even as low as 1150 before finding some support, and we would actually get a lower low. I talk about one last scenario in which it actually breaks through that particular support level, meaning 1150. The next level would be 1042. But as I say on our Outlook 2014, until or if we breach 1154, that's when I would even look at this number and even consider it as a possibility. As of right now, I do not, because my belief is even if we have lower prices, we should find some support at around 1150. We'll have to see how that kind of unfolds, but that's really what I'm looking for in terms of my outlook for the first part of next year, is we have to determine if we hit a secondary bottom and we can react accordingly, because we should go into some sort of an ABC. Or it also could be simply that we are looking at wave 4 of a 5 count rather than a truncated, because as you can see, we come down here. I don't have the count in here, but A, B, and C, our 4th wave. Our 5th wave I've got is a 1, a 2, a 3. I don't have 4 or 5 yet. So what we could be looking at is 4 and then a 5th down, and that would conclude this 5th wave. It would not be truncated. We would get a lower low, but the lower low might be shallow, as low as about 1150. We saw really solid buying coming into the market as this market dipped below 12, and as you can see, it looks like it will maintain itself above 12 over the weekend. Now, silver has been interesting. These are a weekly candles, standard candlestick format, and even though you can see that each week we've made a lower low, and look at the extreme range that we had last week, but even though we've made a lower low, we've had green candles, meaning that it has closed above where it opened that week, but the market has still been tracking to the downside with these lower lows. Next level of real resistance on the upside has got to be 1958, and then on top of that is going to be 1990. Those are the levels you want to look at if in fact silver begins to recoup and move up. Support right now has got to be this particular low right here, which is 1890. This has been Gary Wagner wishing you as always good trading. Have a great weekend. We'll talk to you on Monday for our daily subscribers, and for my weekend review subscribers, I wish you a healthy and prosperous New Year. We'll talk about that later, but most importantly, a happy holiday season. And if you participate, Merry Christmas to you. Have a great weekend. We'll talk to you Monday. Bye-bye.